From the CUBE studios in Palo Alto and Boston, bringing you data-driven insights from the CUBE and ETR. This is Breaking Analysis with Dave Vellante.
Donald Trump's 180 on Intel, well, at least it's directionally correct, certainly more so than calling for the ouster of Lip-Bu Intel's CEO. But a contemplated investment by the U.S. in Intel, as reported by Bloomberg and the Wall Street Journal, without a significant restructuring of Intel's entire business is a recipe for failure, in our view. In particular, we continue to urge Intel's board to spin out its Foundry business. Every day it waits further decreases Foundry's value. Moreover, we call on the U.S. government to use money from the CHIPS Act and its influence on large U.S. chip designers and TSMC to secure a position for a U.S. domiciled company in advanced semiconductor manufacturing. In this special breaking analysis, we explain how an investment by U.S. taxpayers, if structured properly, could actually work. We update our previous bold plan to spin out Foundry and set expectations for why an investment in Intel will take many years and more likely a decade to break even. We're talking about an investment in Intel Foundry specifically, and why that still may make sense. First, let's look at the news. Intel shares are up around 12% in the last 2 days after reports that the Trump administration is exploring a potential U.S. government stake in the company. President Trump evidently discussed the idea with Intel CEO Lip-Bu at the White House this week, with the caveat that talks are early and may not proceed. Now, in an interview with Andrew Ross Sorkin and Joe Kernan on CNBC this morning, analyst Gil Loria of D.A. Davidson called for an intervention, and he called that intervention essential. And he compared the importance to the nuclear arms race in the 1940s. And we agree with Loria that the current situation is untenable and requires immediate action. But, like most discussions around Intel, their conversation danced around the most fundamental issues and the root cause of Intel's troubles, which we have documented extensively on Breaking Analysis. It comes down to lack of volume compared to TSMC. So let's look at that. All right, so this chart shows our estimates of wafer volumes from 2014 through 2024 with an estimate in 2025. When PC volumes peaked in 2014, that signaled the beginning of Intel's troubles. Now, as we reported time and time again, Wright's law, also known as the experience curve effect, describes the dynamic where the cost of producing a unit decreases as the cumulative number of units produced increases. Wright's law suggests that the more something is produced, the more efficient and cost-effective production becomes. Sounds simple, often by a predictable constant percentage with each doubling of cumulative volume. This is especially important in semiconductor manufacturing, where, first of all, the time to go from breaking ground in a manufacturing facility to quality chip yields takes the better part of a decade. And because jumping S-curves to a new process is so expensive, the volume leader increases its advantage relative to the competition, and it compounds as volume grows. So each cycle confers an advantage to the volume leader. So Wright's law explains why Intel's x86 architecture beat out RISC chips in the 1990s, and it explains why ARM volumes have propelled TSMC to its current leadership position, as shown on that previous chart. TSMC holds more than 50% of the market, thanks to ARM and wafer volume customers like Apple, Qualcomm, NVIDIA, and others. And Intel is trying to catch up, but relative to TSM, its costs are 35% higher, and it takes more than a year longer to get quality yields out on advanced semis. So Intel, they're cutting costs, they're scaling down fab investments. The governor of Ohio is complaining. You know, all those promises made under Gelsinger are vaporizing under Lip-Bu because he's got to cut costs. He's got a different strategy. Meanwhile, TSMC continues to expand its lead, and this has put Intel Foundry into a death spiral. And the numbers don't lie. Here's a 3-year look at Intel's business from 2022 to 2024. Revenues down 15%, gross margin down 10%, operating profit down 33 points. $75 billion shelled out in CapEx, market cap down 20%, notwithstanding this week, cash down 22%, debt up 23%. So, okay, let's take a longer term look back at Intel, going back to when PC volumes peaked in 2014. It's even more telling, as this chart shows. Revenues have contracted during one of the greatest 10 years in tech history. Gross margin, more than halved. Intel was the gross margin leader, was selling hardware for its mid 60% gross margins, at the high perch in the mid 60s. Its operating profit swung from a strong positive to a huge loss. CapEx and debt have both more than doubled. Market cap has dropped by over a third. Cash on hand rose modestly, around $8 billion, but debt increased by roughly $36 billion. So this highlights how Intel has shifted to an asset-heavy, lower margin model with much higher leverage than it had last decade. And the company took advantage of ZERP and in the process lost its paranoia, an homage to Andy Grove. And in case you're not getting our premise, the problem is Foundry, as shown here. Intel's core design and product business, such as for client computing and data center, continues to serve as the primary engines of both revenue and profitability. And these segments remain the company's competitive and financial backbone, in our view, generating the bulk of sales and sustaining margins despite broader industry headwinds. In contrast, the Foundry business, now reported as a separate segment, delivers far less revenue, most of it derived from internal customers, by the way, while consuming the lion's share of Intel's capital investments. This capital-heavy operation posts substantial operating losses, $13 billion last year, making it a structural drag on the company's financial performance. So the combination of persistent operating losses, high asset intensity, limited external customer adoption, and outsized capital expenditures in the Foundry business, they materially depress Intel's overall margins and returns to shareholders. And this dynamic underscores the challenge of balancing long-term manufacturing ambitions with near-term profitability goals. Intel's move to split financial model to show that transparency has further shone a light on the disparity between its two main businesses. And the disclosure makes it clear that the Foundry segment is absorbing disproportionate resources relative to its revenue contribution. We knew this, it just quantifies it, and that it remains meaningfully unprofitable when compared to the company's core design operations. So what's the solution? It's been plain as day for the last 5 years. Spin out the Foundry business and allow the product group to flourish. The question is, how do you do that? So this chart updates our original bold plan, which simplifies the cap table and makes some adjustments to secure U.S. majority control. Our original plan called for more participation from chip designers like Apple, NVIDIA, and the hyperscalers, and that still could happen. We'll get to that momentarily. But to simplify the argument, we've created the cap table as shown here. The proposed structure for spinning out Intel's Foundry into a new, what we called last year, Foundry of America, that entity underscores the scale, complexity, and geopolitical weight of this initiative. So under the structure that we're showing here, U.S. taxpayers, via a combination of the CHIPS Act funding and direct equity injection under the Trump administration's manufacturing push, would take a controlling 51% stake in the entity. And that majority position is designed not just to inject capital, but to guarantee U.S. leverage over advanced semiconductor manufacturing capacity at a time when supply chain security is a national priority. TSMC's participation at 30% brings not only a massive $30 billion commitment, carve out some of that money that we're basically enticing TSM to put in its own manufacturing facility and give them a big chunk of this joint venture. But it also has to include critical intellectual property and operational expertise that's required to make the venture globally competitive. Without TSMC, this takes 10 to 15 years longer, unlimited capital, and we don't think the industry, the shareholders, the government has the patience for that. So anyway, this reflects a pragmatic recognition that U.S. fabs alone cannot quickly replicate the scale and technical leadership that TSMC commands. And it inherently creates a hedge for TSMC, this is really important, and its suppliers in the event that China takes over Taiwan. Therein lies TSM's motivation. Intel itself holds a modest 10% stake, which is going to really upset shareholders of Intel today, but this is the reality. So they get that 10% through the contribution of fabs, which again, we've said are basically of negative value without this type of venture. And they're putting in intellectual property for things like 14A. So we've assigned a discount here on the hypothetical value of $5 billion. While it's small in percentage terms, Intel's role would be still foundational, as the venture would be seeded with existing manufacturing footprints and engineering talent and equipment. Private equity kicks in with 9% ownership, which is achieved through a $5 billion equity injection and $20 billion in debt financing secured by the joint venture. This capital structure signals that private markets will still have a role in funding and driving efficiency, but because the break-even for this venture is so long, it's going to be a decade or more, we need to give private equity yield over the period, and that's where the debt instrument comes in. So in our view, this mix of public capital, TSMC expertise, domestic assets, and private funding could give the U.S. its most credible shot in decades at not only reshoring, that's important, but also controlling a meaningful share of advanced semiconductor production by a U.S. domiciled company. Now, it admittedly bakes in some governance complexity, balancing national security interests, global partnerships, and the commercial realities of a capital-intensive, fiercely competitive industry is not easy. Now, we're working backwards from the cap table, but that's only a starting point. We still need more cash. There's some necessary conditions for this to succeed. And not only the cash, that's super important, but also wafer volume commitments, which brings us to the hyperscalers and other tech companies that are committing hundreds of billions of dollars in an effort to placate President Trump and putting that toward AI. And why the administration has not connected the dots between these massive investments in AI and the need for an American foundry is beyond explanation. So let's look at what this might look like. Alex, if you please bring this up. The Foundry of America will only achieve long-term viability if it can secure both sustained wafer scale volume and substantial upfront and milestone cash commitments from anchor customers. So the take or pay model outlined here is designed to provide exactly that, locking in predictable demand from the largest semiconductor consumers, the chip designers in the world, while de-risking capital-intensive build-outs for the Foundry of America. Now, under this structure, leading technology companies, Apple is the big volume leader, but NVIDIA, AWS, Google, Microsoft, Meta, and Intel's own product divisions commit a combined $26 billion in upfront payments, and then $22 billion in milestone payments over the first 5 years of this project. And these funds provided are essential for working capital, and they help offset the massive upfront CapEx required to build and equip advanced labs. Now, in parallel, the contracts secure a baseline of nearly 300,000 wafers per month, starting in year 3. So that gives the foundry the scale needed to get on the Wright's Law learning curve, crossing over the 10 million plus annual wafer volume, benchmark. The durability of these agreements, most spanning 7 to 10 years, ensures a predictable cash flow, supply stability for customers, and then the operational visibility for the foundry. More importantly, these volumes and cash flows underpin financing for further capacity expansions and technology node transitions, both of which are necessary to remain competitive with TSM and Samsung. Now, without this combination of committed volume and upfront capital, the Foundry of America risks falling into the same trap that has historically plagued new entrants, i.e. underutilized capacity, weak returns, and an inability to keep pace with the industry's relentless capital and R&D requirements. Just look at global foundries after they were paid to take IBM's microelectronics division. They couldn't do it. Why? Wright's Law. So what did? They dialed back to, less advanced semiconductors and are doing quite well as a result of that. Okay, but coming back to the need for advanced manufacturing, not only physically located in the U.S., but domiciled headquarters in the U.S., in our view, locking in these contracts with these hyperscalers and these other volume suppliers is as important as the ownership structure itself, because without the guaranteed demand and the robust cash buffer, even majority U.S. control would not be enough to secure a sustainable domestic alternative in advanced semiconductor manufacturing. So this structure brings $138 billion in assured funding over a decade, which we believe will be required. We think it's definitely north of $100 billion. And it will take a decade at least for the new venture to be competitive in our view. Now, in a previous post, we laid out the motivation for these chip designers and TSMC to play ball. The short answer is Trump will make them. The fact is they're already committing hundreds of billions of dollars in combined to fund AI, so we have the confidence that the current administration could get them in a headlock if they have to and make it happen. All right, let's close out with some final thoughts here. The bottom line is that this plan represents a bold, high-stakes intervention aimed at securing U.S. leadership in advanced semiconductor manufacturing. While the economics are going to be challenging and break-even is years away, the strategic rationale is sound in our view. Spinning out Intel's Foundry operations into a standalone American Foundry creates a vehicle that can absorb significant public and private investment. It can attract world-class expertise and talent and lock in long-term demand through guaranteed wafer contracts. By separating manufacturing from Intel's product group, the company can focus its energy on competing in CPUs, GPUs, AI accelerators, PCs, and emerging architectures like ARM and RISC-V, free from the operational and financial drag of running a capital-intensive foundry. Meanwhile, the foundry benefits from taxpayer backing, corporate anchor tenants, and TSMC's operational know-how, which gives it a credible path to global relevance. This approach is, is without an identical precedent in modern tech policy, but it does echo moments in history like the nuclear race of the 1940s, when national imperatives demanded extraordinary measures. The stakes in semiconductor sovereignty are simply too high to ignore, and in our view, the Foundry of America could become the cornerstone of a resilient U.S.-controlled supply chain for decades to come. All right, we're going to leave it there. Thank you, Alex Myerson on production and for managing our podcast, Ken Schiffman as well. Kristen Martin and Cheryl Knight help get the word out on social media and in our newsletters, and Rob Hof is our EIC over at SiliconANGLE. Remember, all these episodes are available as podcasts wherever you listen. Just search Breaking Analysis Podcast. I publish each week on thecuberesearch.com and siliconangle.com. Want to get in touch? Email me, david.vellante@siliconangle.com. You can DM me at dvellante or comment on my LinkedIn posts. And check out etr.ai for the best survey data in the enterprise tech business. We didn't have any ETR data today, but check them out. This is Dave Vellante for theCUBE Research Insights powered by ETR. Thanks for watching. We'll see you next time on Breaking Analysis.